Hello friends, let us continue with share capital. Friends, if you remember in the very beginning I told you when we discussed about issue of shares, there I told you that issue of shares can be either for cash or for consideration other than cash, right? See, all the important topics are here. This is just a small topic that has been touched, that is consideration other than cash. Important part is this cash part that we have discussed about oversubscription, undersubscription, preparation of cash book. So this is all very, very important, right? So this is just a small topic, that is consideration other than cash, issue of shares for consideration other than cash. In this lecture, we are going to deal with this topic, issue of shares for consideration other than cash, right? Issue of shares for consideration other than cash. Now what is happening in this case? What we do in this case is, suppose a company purchases an asset, right? Company purchases an asset, right? What is the journal entry for this? The journal entry for this is asset account debit to vendor. Vendor means the person from whom we have bought the asset. And when the payment is made to this vendor, what is the journal entry? Vendor account debit to bank account. Isn't it? Suppose a company purchases an asset. In that case, our journal entry is asset account debit to vendor account. Then when the payment is made to the vendor, the journal entry is vendor account debit to bank account. Now in this case, what we are going to do is, we are not making a payment to the vendor through bank, right? What we are doing is, in this case, instead of making payment to the vendor through bank, company issues shares to the vendor. Clear? Now see, when we issue shares for cash, what does that mean? We are getting money from the public, we are issuing them the shares, we are getting the money from the public, and we are going to use that money for the business. Here, instead of getting the money, we are getting an asset, right? In other words, if you see, we are getting an asset. That asset we are going to use for the business, and against that asset we issued the shares to the vendor. So in this case, instead of this entry will not be passed because we are not making payment through bank. What will be the journal entry? Vendor account debit to share capital. Right? Vendor account debit to share capital account, and if you see the net effect of these two entries, this vendor will be cancelled here. What is the net effect? Asset account debit to share capital. We issued the shares, we received cash. Here we issued shares and received an asset. So cash has been substituted by an asset. Simply putting, cash has been substituted by an asset. In normal case, in a case of issue of shares for cash, what we do is we issue share capital and we receive cash from the public. That cash we are going to use in the business. In this case, what we are going to do is we issue the share capital, and instead of cash, that person gives us the asset. That asset we are going to use for the business. So what is the journal entry? Asset to share capital. Clear? The net effect of the entry is asset account debit to share capital account. Clear? Always try to see the net effect of the entries. Clear? So what are we going to do in issue of shares for consideration other than cash? First entry will be asset account debit to vendor account. This is with the purchase consideration, amount due towards the vendor. Now instead of making payment through bank, what we do is we issue shares to the vendor. Right? We are issuing shares to the vendor. Clear? Now, this was the case when a company purchases an asset. I'll take another case now. The other case will be where a company buys a whole business. Where a company buys a whole business. Now, what does the entry in this case? If a company is buying the whole business, what does that mean? Company will be buying sundry assets. I can say sundry assets. Account debit. You are a company, you bought a business of someone. So you bought their sundry assets, that will be debited because it is a addition to your assets. You will buy its liabilities also. You will buy the liabilities also. Clear? And you will identify, you will see what is, you will finalize the amount that is payable to the vendor. To vendor account, this is the purchase consideration. This is purchase consideration. Suppose this assets were 9 lakhs. Right? Sundry liabilities were 5 lakh. And you decided to pay vendor 5 lakh rupees. Now see, the debit and credit side are not equal. Here you have 10 lakh and here you have 9 lakhs. That means you have taken the net assets of 4 lakh rupees and you are paying him 5 lakh rupees. You are paying him extra. Net assets means sundry assets minus the sundry liabilities. This is our net assets. That means you are taking the net assets, net benefit of 4 lakh rupees. If you are taking the liabilities, you have to pay that 5 lakh rupees. Right? So what is the net effect? Net assets you are taking of 4 lakh rupees, but you are paying him 5 lakh rupees. Why you are paying that extra 1 lakh rupees? That extra 1 lakh rupees is because of the goodwill, the reputation of the firm in the market. For that you are paying 1 lakh rupees extra. Clear? That 1 lakh rupees you are paying extra for goodwill. Now, other case, if I say this goodwill is not there. Suppose this goodwill is not there. Okay. The sundry assets are for 11 lakh. Now, what is the case? Net assets are more than the payments. In that case, we will write to capital reserve account 1 lakh rupees. Right? Simply putting, in the very simple layman terms, I will say if liabilities, if the credit side is more than the debits, it will be goodwill. If debit is more than the credit, it will be capital reserve. Make a note here. Either goodwill or capital reserve will appear in the above entry, right? So the balancing figure will be either goodwill or capital reserve, and there is a possibility that both of them are not there. If the payment is equal to net assets, then neither goodwill nor capital reserve will appear. Clear? So this is the journal entry in case a company buys a whole business. Now, when this vendor is to be paid 5 lakhs, what will be the journal entry? We are not making payment through bank, we are issuing the shares. What will be the journal entry? Vendor account debit to share capital 5 lakh and 5 lakh. Clear? So this is how you deal with issue of shares for consideration other than cash. That means there are two cases: either the company is buying an asset or the company is buying the whole business. Right? In both the cases, we have to make the payment to a person. That person is known as the vendor. Right? And instead of paying through bank, we pay that vendor through issue of shares. We issue him the shares. We are not issuing him the bank. We are not paying him through bank. We issue him shares. Right? So our share capital will be credited, and the asset, ultimately the asset will be debited, and that asset we are going to use in the business. Clear, friends? Let us see a practical problem. Let us do one example. X Limited bought the business of Y Limited for rupees 1,80,000 payable in fully paid shares of rupees 100 each. Right? Now in this there are two cases: issue of shares is at par, and number 2, issue of shares is at a premium of rupees 20. Right? They say pass necessary journal entries. Pass journal entries. Clear? X Limited bought the business of Y Limited for 1,80,000, and they say the consideration is payable in fully paid shares of rupees 100 each. Now there are two cases. The first case is issue of shares is at par, and the number 2 is issue of shares is at a premium of rupees 20. Right? See, in both these cases, first step should be to find out the number of shares. Consider case 1. Find out number of shares. Right? Number of shares is equal to, what is the purchase consideration? Right? Divided by issue price. You will get the number of shares that a company is issuing 1,80,000 is the purchase consideration and issue price is 100 rupees. So company will issue 1800 shares of rupees 100 each to pay 1,80,000. Isn't it? Simple mathematics, you can find out. Now, what will be the journal entry for this? First of all, you are buying the company from Y Limited. So the first entry will be sundry assets. This is net assets I am taking because assets and liabilities separately are not given. To Y Limited, my vendor. How much? 1,80,000. Now my issue of shares is at par. I will issue shares to the vendor Y Limited account debit to share capital. Right? How much shares I am going to issue? 1800 shares. 1800 shares at the rate of rupees 100. So I will issue him 1800 shares 1 lakh and pay him 1,80,000. Clear? So always first find out the number of shares. Number of shares is equal to purchase consideration divided by the issue price. That way you are going to find the number of shares first. Right? Case 1 is clear when issue of shares is at par. Now issue of shares is at a premium of rupees 20. Find out the number of shares. What is the purchase consideration? 1,80,000. What is the issue price now? Is it 100 rupees? This is 100 plus 20. Because we are issuing at a premium of 20 rupees. So company will issue 1,500 shares. Ultimately, you have to pay him 1,80,000 only. You have to pay the shares of 1,80,000 only. But here you are issuing at a premium of 20 rupees. What will be the journal entry? This first journal entry will remain same. That is sundry assets account debit to Y Limited account. This is 1,80,000 and 1,80,000. Now what you are going to do is Y Limited account debit to share capital because you are issuing the shares to vendor. What is the amount for the vendor? 1,80,000. Now how much you are going to transfer to share capital? You are issuing 1,500 shares at the rate of rupees 100, 120. You are issuing 1,500 shares at the rate of rupees 120. Out of that 20 rupees is premium and 100 rupees is the face value. What is the amount that you are going to transfer to share capital? To the share capital you will transfer only the face value. So 1,500 shares multiplied by 100. And where will the premium go? The premium will be credited to securities premium reserve account on 1,500 shares at the rate of rupees 30,000. So that is why we are calculating this number of shares so that we can exactly know the amount which is to be transferred to share capital and the amount which is required to be transferred to securities premium reserve account. Right? So friends, if the question you get for consideration other than cash, this type of question if you get, first of all find out the number of shares. Right? So this is how you deal with issue of shares for a consideration other than cash. Clear? So if you have any queries friends, just send me an email at ksjteaching@gmail.com. Right? in the next lecture, what we are going to discuss is issue of shares to promoters and underwriters, right? So in the next lecture, we are going to discuss again a very small topic, that is issue of shares to promoters and underwriters. So that's all for this lecture, friends. Thank you so much.